words for it, but we'll just keep it at the Paycheck Protection Program. And Jamie Card, partner of the financials and the financial institution team leader, and Marc Valerio, a partner of the Bonadio Group. They will provide some current updates on PPP, and I think it's probably changing every day, but I don't know how many changes you have in your deck, but I think we're hopefully getting closer to a forgiveness program here soon. But I do have to say is that Jamie, Marc, Paul Freeze, and many others from the Bonadio Group have been great supporters of IBANYs. I'm sure many of you have seen or met them through the travels and many of our educational sessions over the last few years. I really do appreciate the support you guys have given IBANYs over the years. I know you do a lot of work, got a good work for many of our community banks here in upstate New York. So with that, I will allow you guys to take this on. I'm sure there's going to be a few questions. I will tell you right now that we have a lot of people who seem to be shy using the chat box. So if they don't ask questions, you might have one or two from me. So, but having said that, Marc, Jamie, please take it away.
All right, thank you, John. Nice to see you. So as John indicated, we're going to be walking you through some payroll or Paycheck Protection Program information. And also, as he mentioned, there was some information that came out yesterday that makes the end of our slides a little outdated, but Marc will go over that. So as John alluded to in the opening, Marc and I are both partners in the Financial Institutions Group, and Marc is honestly one of our leading experts on PPP and the CARES Act. So he will be walking you through the majority of this presentation, and I will jump in at the end with the accounting update from the AICPA and information on that. And then as you previously saw on the last slide, our disclaimer, so this information is just for general purposes. It is not specific information or advice, and that it's our opinions and not necessarily the opinion of the firm. So Marc, do you want to take it over, beginning with the Paycheck Protection Program timeline?
All right. Thank you, Jamie. Thank you, John, for the kind words. So I was going through my notes last night and maybe talking out loud, rehearsing, whatever you want to call it. And my mother has been staying with us for a little while since we had our third kid, helping out, and feels the need to interject with everything. So she said to me, you know, shouldn't you include some sort of cartoon or tell a joke or something? This is very dry. And I told her that, you know, I'm an accountant and I was presenting to a group of bankers, and, you know, I don't know that we needed much humor in this, but I will say, you know, I've been living this for 6 months, as I know all of you have. Things were changing fast and furious, and as we'll get to here. And I don't have a better analogy to compare to. Now, I know it's been very helpful. It saved a lot of jobs, and I've talked to a lot of businesses that it's really, you know, been critical for their ongoing survival and maintaining people. But for quite some time, it did feel like the movie Groundhog Day, where you just kept waking up and doing the same thing over and over with the ever-changing rules and having to learn and relearn and retrain and start over again. So,
So Marc, are you Bill Murray? Is that what my understanding is?
I'm not Ned Ryerson, but I'm one of the
insurance guy. Ned, I got you. Okay, sorry.
No, good. Trying to add humor here. Thank you. So starting with the timeline. You know, things were moving rapidly in March. We had phase 1, phase 2 stimulus bills. And within a matter of, you know, a couple of weeks, the passage of the $2 trillion CARES Act that included the initial $349 billion for PPP. And I've wondered, you know, where did they come up with this so quickly? They must have had something sitting on the shelf ready from the financial crisis. And you know, at some point in time when we have time to sit back and reflect, I'd be interested in learning what happened. So they put this on you. You didn't necessarily ask for it. And then you had a week to figure it all out, and the application process opened up April 3rd. By April 16th, PPP funding was fully exhausted, and there were quite a few people that were unable to obtain a loan in that short amount of time. So 8 days later came the passage of the PPP and Healthcare Enhancement Act that included an additional $310 billion in funding for PPP. Applications resumed 3 days later, and the spigot was back open. So about 6 weeks into the process, well, we had been working with a lot of clients and advising people on how to strategize best to maximize forgiveness and use all the funds. And then came the PPP Flexibility Act, which really, was the most substantial change to the PPP rules and provided a significant amount of relief to borrowers, the biggest of which the 8-week to 24-week, which we'll go over in a few slides. And then on July 1st, technically PPP had closed and expired on June 30th. The Senate extended the deadline to August 8th. And, the timing of that extension seemed to coincide with the planned recess. And I think at that point in time, there was significant belief that there would be a bill that passed both houses and was signed that would have sorted all this out. And we'll go into that at the end here. But August 8th was the official close of PPP with $525 billion in loans issued and nearly $134 billion of unclaimed funds. So on August 10th, the SBA officially opened their PPP forgiveness platform to start accepting forgiveness applications. So that's really the key timeline, but obviously some other substantial events happened in the middle, and some other key dates that I've highlighted here include, between April 1st and August 24th, you had 24 interim final rules that were issued. And from April 3rd to August 11th, there were 51 FAQs issued. On May 1st, lenders received the guidance on the wholesale loan sales of PPP loans. And on May 15th, this is when we received the first version of the loan forgiveness application template, later to be revised when the PPP Flexibility Act passed. On May 21st, you received the processing of fee payment and 1502 reporting process, which was further amended July 13th. June 16th is that date I previously referred to. Version 2 of the loan application came out along with the Form EZ 3508 EZ. And then on July 23rd, you received the information and instructions on the lender submission for forgiveness decisions process. And that's when they announced that the portal would open up on August 10th with further instructions to come. And between August 4th and August 11th, the SBA put out 26 FAQs just specific to loan forgiveness. So, I don't have to tell any of you. I think you've all been kind of in the weeds on this for over 6 months now, but that's a lot of information that has been put out, and there's still some holes and some diversity in practice and some interpretations that many are looking for. And we'll talk about some of those as we go on here. But it's, I don't envy the position you've been in trying to keep your customers afloat and also give them the best answer. And then with the forgiveness process, I mean, it's been, people are accepting applications. Some have started to submit. I'd say the bigger banks have not yet. They seem to be kind of mixed bag as well. And we're all waiting on Congress to sort it out for you. So just to quickly highlight the changes from the initial CARES Act to the PPP Flexibility Act, as for those that don't know, I guess if there's any, initially you could borrow based on your 2019 payroll. So a business comes to you and they present the numbers, and their loan amount should equal 2.5 months worth of 2019 payroll expenses. Obviously, there were exclusions for people over $100,000. Income was capped there. Owners initially in partnerships weren't able to borrow, and other things like that. But so initially you had 8 weeks to use those funds. You borrowed about 10.5 weeks of payroll, and you had 8 weeks to use them. And most of that had to be on payroll expenses, 75% at the time. That wasn't in the CARES Act. That was a SBA rule. With the Flexibility Act, they extended that to 24 weeks from the date of the disbursement of loan, and the borrower has the option to use the 8-week period or the 24-week period, or potentially some period in the middle, but there's no firm guidance on how that works either. The next item that was changed, the law cemented in the 60% threshold. 60% of the amount borrowed had to be used on payroll expenses. Initially, this looked to be a cliff, but the SBA later put out a fix for that. So 60% can be used or more on payroll expenses. If less is used, you just lose that difference from 60 to 50 on your forgiveness. For maximum amount of employee costs, again, initially it was $15,385 that could be eligible for forgiveness per employee, and that's really just a prorated 8 weeks over 52-week calendar year applied to the $100,000 cap. When you go out to 24 weeks, you can get up to $46,154. And then the last item here, owners are capped at $20,833, and there's no real magic to that number. That's the amount they borrowed based on their compensation, assuming they were W-2. Some other items worth noting, there's FTE safe harbors and there's FTE exceptions. The exceptions, some of these were added by the SBA over time. Some of them were cemented by the passage of the Flexibility Act on June 5th, but you've got a few that we've listed here. If borrowers are unable to return employees, but they made a good faith written offer to an employee, they can receive credit for that person. It should be in writing. And then they're also required to report them to the state's unemployment office if they reject the offer. And then any position for which they had previously reduced hours or reduced wages, same thing, you make an offer to return them to normal. And if it's in writing and rejected, you can count that as well. And then the last item here, there's 3 ways that you can also count these individuals as FTEs during the covered period. Those that were fired for cause, and the documentation for all this is essential, voluntarily resigned or voluntarily requested and received a reduction in their hours. And then on the safe harbors, first I'm going to go over number 2. These are kind of out of order here, but number 2 was really, that was in the CARES Act originally. And step 1, you measure your FTEs, average FTEs in the covered period, compare that to the lower of 2 base periods, one being last year, 2/15 to 6/30, 2019, the other being this year, 1/1 to 2/29, 2020. To the extent you had a reduction versus the lower of those 2 base periods in your covered period, then you get a pro rata reduction in your forgiveness, eventual calculated forgiveness. However, they said if you restore that reduction back to where it was at February 15th, no later than December 31st, then you that first test will be thrown out and you've been deemed to met the safe harbor with no additional reduction in your forgiveness. And that's an all or nothing test. This other one, number 1 here, was established by the PPP Flexibility Act. And this one effectively says that if you're able to document that you were unable to operate between February 15th and the end of the covered period at the same level of business that you were prior to February 15th due to an order that was issued between March 31st and December 31st by either CDC, HHS, or OSHA, then you can, that FTE reduction would be thrown out if that's the cause. So this one is interesting because when it was first put out there, most realized quickly that they were not necessarily subject to a direct order from CDC, HHS, or OSHA. So later the SBA came out with guidance in one of the interim final rules that indicated that indirect orders, so orders from your governor, from your mayor, or others, would qualify if they're following the guidance of those entities, most commonly the CDC. So to me, the easy slam dunk cases for this are bars, restaurants, any entertainment business, movies, museums. But I've talked to a lot of businesses that feel they qualify for this as well because indirectly they were impacted. So it puts you again in a tough position when your borrowers are presenting you with this safe harbor and they're not necessarily black and white slam dunk officially shut down and their business was impacted. So that one's a little gray area on that one. And then the last three things here that the Flexibility Act did when it passed on June 5th. Initially, the CARES Act said that payments were deferred for 6 months from the date of loan origination, and that was modified to be 10 months from the end of the covered period. So if a borrower is using the 24-week covered period, they can go out 10 months from that. And this puts most of your loans out to mid next summer, maybe August, before any payments of principal or interest would be due, if there's no forgiveness applied for or anything like that. The other thing that changed, the FICA tax deferral, the OASDI 6.2% employer portion. Initially, guidance was out there that borrowers could not defer that employer portion unless, and if they had PPP. Then guidance came out that said, okay, they can defer it, but only until they receive forgiveness. And then the PPP Flexibility Act threw that out and said they can defer it right till the end of the year, just like everyone else, with or without PPP. And just so you understand, that 6.2% employer portion is deferred via reporting on your 941s until the end of December, and then you have 2 years to pay it back. Half is due on December 31st, 2021, and the other half is due on December 31st, 2022. And you know, why would people do this? A lot of businesses cash strapped and, you know, looking for any way they can to save money and improve liquidity. And, you know, if they're out on their line of credit, that's one consideration that they've taken. And the other thing is, initially for PPP eligibility purposes, and still, but the employer portion of payroll taxes it's not an eligible cost. So it was one thing they would have had to pay that they were not receiving PPP reimbursement for. And then the last change here, and this is really the only one from the PPP Flexibility Act that was not retroactive. Any loans issued after June 5th are a 5-year term versus those that were from the CARES Act through June 5th, a 2-year term. As John said, if there's any questions throughout, just pop them in the chat or raise your hand or whatever we're doing here. Quick survey we did back in June. So this content's a little dated on the survey, but we had a presentation and we sent a survey out to probably close to 500 financial institutions throughout the Northeast. And you know, our responses, the larger ones did not respond, as you can see here, based on the demographic, but it was a fairly even split. Those under 250 to 500, and 500 to $1 billion. Just so you understand who's in this population here. Next slide. And the number of institutions, based on those that responded, the average loan, total loans for each was about 200, it's actual 298 was the average. And the aggregate value of those originated was $27.1 million per institution. And the aggregate SBA origination fees on average was $1.1 million for those responding institutions. So how would you rate your PPP experience? Probably no surprise here, but 58% said very challenging and 14% said bad. So there were 28% that had it as fair or good. I'm sure you're all on this call. Next question was, who in your institution is responsible for PPP compliance, process design, monitoring, et cetera? For same thing, close to 58% was lending, is kind of leading the charge. And for others, it was, you know, all hands on deck, whoever's willing, or a PPP cross-functional team. And I think that's generally what I've seen. The lending group is kind of leading it, and then they're grabbing resources wherever they can, especially for this forgiveness process, which is much more labor intensive on your end. And then the last item here, you know, how does your institution plan to handle forgiveness? Again, this was back in June. I assume that the blue would be a lot smaller here, but at that point in time, close to 75%, we're still trying to figure it out. We were, I believe, still waiting on updated interim final rules based on the PPP Flexibility Act at this point in time. We did not receive the forgiveness interim final rule update, and all those FAQs that came out. So I think what I've seen actually is many have moved closer to that utilizing technology. But I've also seen, at this time, less than a quarter, we're talking about scheduling out applications. And that seems to be, with the community banks I'm talking to, the trend that I'm seeing. And it's kind of talking to both sides of the PPP loan, it's putting a lot of pressure on the borrowers. And some of them don't necessarily understand any of it. And they're just like, well, my bank said I have to apply, else I'll be pushed to the back of the line. And I can't get in until next year. And, our tax people are telling them, well, for tax purposes, you may want to wait. And it's been some interesting discussions, but it seems like most just want to get it off their plate. And if Congress fixes the tax thing that we'll talk about a little later, then so be it. But otherwise, let's get it in the past.
Mark, if I may interrupt you, we have a question that might make sense to answer now, if that's okay.
Yeah, perfect.
Question from the crowd is, how do we account for the loan fees received by bank lender?
We're going to get to that.
We're going over that soon.
The next slide.
Perfect. All right. Well, forget that then. Did I ask?
No. And then lastly, just the forgiveness process, which I know you're all aware of, but borrower completes the forgiveness application. The lender reviews the application and makes a decision, and this is required within 60 days of the receipt of that application. And then the lender requests payment from the SBA at the time that they make their decision on that and give it to the SBA. And then the SBA has 90 days. The $2 million ones and up, they're going to review, audit per se, and those under, they will use their discretion. But they have 90 days to make that decision and render that decision then to the SBA or to you. So with that timely question, we will now go into the accounting implications of all these things and specifically what the AICPA has said about them.
Hey, Mark, though, before we jump into this, we did get a question about what are your thoughts on whether there will be automatic forgiveness for PPP loans under a certain threshold. The 150,000 is being thrown around now. Do you want to comment on that now?
Only because I have a couple slides on this at the end. I will hold off on that one as well.
Okay, great. So this information is from the AICPA technical guidance that was issued back on June 30th, 2020. This guidance included information for both borrowers as well as lenders. So we're going to go over the 4 items here that relate to the lenders. The first bullet point relates to the classification of advances under the Paycheck Protection Program. We didn't really have a lot of clarity that was required as a result of this, but they did confirm that the instrument is legally a loan with a stated principal, interest, and maturity date. So the institution should be accounting for these as a loan. The second item that was addressed was the consideration of the SBA guarantee under the Payroll Protection Program. So the question was, is the guarantee from the SBA considered to be embedded as opposed to a freestanding contract, and thus can it be considered in estimating the credit losses on a loan? Well, the answer is that it is in fact embedded, and it should in fact be considered when you're taking into account the allowance for loan loss as it relates to these loans. So it should not be accounted for as a freestanding contract. Accounting for loan origination fees, and this is one I think that everyone has talked about quite a bit. So what is the accounting for the fee received or receivable from the SBA for ongoing originating the loan and the potential callback of the fee? So this loan should be accounted for in accordance with FAS 31020. It is a non-refundable loan origination fee. So therefore, it will be offset against loan origination costs and deferred over the life of the loan. And then it's also adjusted to the yield. So then the question about the clawback comes into play. And because this is deemed to be not a refundable fee, it is more in line with being a penalty or a provision. You would take into consideration later doing a contingent liability assessment and not necessarily account for it as a non-refundable fee. Mark, do you want to chime in at all on that? You're muted.
Sorry, I was reading something here. What was the question again?
No, I was just talking about the that the fee is not subject to clawback, and that you should be doing contingent, liability assessment as it relates to that. But the recognition should be over the life of the loan, and not necessarily taking into any sort of consideration that it is non-refundable in nature. And
Yes.
the only thing that from, again, the AICPA conference that we attended a couple weeks ago, I know we had some discussions early on about these, that you could maybe take a look at whether you could accelerate these in matching them and saying that we expect these loans to mature more quickly. But they made it very clear at that conference that you should be using the term, and that since there's been no other loans similar to these issues previously, there's no history to go on to determine a more accelerated life for the recognition of these fees.
Yeah, that's exactly what I was going to say. The guidance is semi-vague. It says if you can estimate, but from talking to the individuals that were leading the discussion at the AICPA, which included your regulators, they were very clear that you have no history with PPP, and history is the entire basis for estimating prepayment. So they were not going to look favorably upon those who recorded any, I'll say, material amounts as a prepayment.
And as it relates to clawback, Mark, it's really only that a contingent liability should be considered if in fact you believe that there is, any sort of issue with the underwriting or issue with the information submitted. So that should be, in the grand scheme of things, an unusual case, right?
Yeah. Yes. However, because of that timeline we went through, and you received this law and you didn't have the guidance before you wrote the loans, it was I've seen at least 2 or 3 and maybe 4 or 5 where businesses received loans either for significantly more than they should have, or they were not actually eligible. Either they felt they qualified for an alternative size test, but they didn't because of their entity type, or they were a nonprofit. This is the one I've seen most commonly, but they were not a 501c3. This could potentially be corrected by the HEROES Act. And their lender has notified them, and they have X amount of days to remedy it, or it's going to be booked as a loan. But those are ones that I would, I'd really be careful about, because when they go to the SBA, I would assume that the type of entity would quickly be able to be determined whether or not they qualified or were eligible. As for their ability to truly dig in the weeds and audit things, I don't know that they have the manpower or resources to do that. But initial eligibility is the big one right now, or loan amount is the one that we've seen commonly.
Okay, so we did receive a question. What is the implication if we do not defer the loan origination expenses and amortize over the life of the loan? We did not handle our expenses this way. We just expensed as incurred. And Mark, you and I can both answer this, but I think we've seen in a lot of instances that loan costs were not deferred because as we've discussed, with clients and so forth, that the typical C&I deferred costs would not be appropriate in this case. So unless you did a workup and determined the standard cost for a PPP loan, you obviously wouldn't have that cost available to defer. I think if you could do an analysis and quantify what you believe it was, and then show that it was immaterial, your financial statements taken as a whole, that would be appropriate. Mark, do you have any thoughts on that?
No, I think that's reasonable. I think the real costs and time are going to be on the forgiveness process, but I don't think there's any guidance on potentially hanging those up on the balance sheet.
But I do think if you don't present quarterly information, if you're not an SEC registrant, that you could do this evaluation for year end and true it up. so that your financial statements appropriately reflected this deferred cost. But if you have any additional questions on that, please let us know.
Yeah, I think, back in April timeframe, everyone kind of felt like this would all be flushed out by the end of this year. And now we're looking at it with many not even accepting forgiveness, that there's going to be a balance sheet impact at the end of the year. So, there's time to remedy all of that still, but I would implore to make sure we get it right and we're following the guidance, and we don't have to go through the next exam and find out that your regulator is not pleased with the way you booked it.
Right, and now is the time to be talking to your auditors about this to ensure that, like Mark said, going into year end, that your numbers are accurate. So then going hand in hand with this, the last one was about accounting for the loan repayment or forgiveness by the SBA, and we've received quite a few questions about this over the past couple weeks. So they have explicitly indicated that the accounting should follow the cash repayment of the loan. So whether that's from the SBA or if it's from the borrower, that is how the deferred fee income should be recognized. And so that means, when we were just talking about how the forgiveness process works, so not until the cash is actually received by the bank.
Yeah, with this one, I think a lot of people were planning on recording that as soon as they submitted the application, but they came out, again, this was an amended update here in August, and said, no, you need to wait until you have a decision, or you think you have a decision.
Right.
All right. So I think we answered the question we had on the fees. With that, I have a duplicate slide here. Sorry about that. So just a few other matters I thought we'd discuss, and this is kind of the piece where we had some action yesterday that potentially changes some of the things in these last two slides here. But there's obviously a fair amount of ongoing uncertainty, and this is resulting in inflated balance sheets. This was a hot topic as well at the AICP conference. The last bullet here talks about some of the implications. I mean, if this is pushing you over 500 million or $1 billion, there's significant implications on your financial reporting, on the independence rules, on potentially an integrated audit, and this creates a lot more work for the bank and compliance requirements. The other thing, the extension of the 8-week to 24, obviously, that we just talked about, push things out, and this whole process is potentially going to carry over that 12/31 date. There's uncertainties regarding various rules and interpretations, eligible costs, FTE measurement questions, and we're waiting on additional congressional action, like we talked about previously, and we'll talk about a little more on the next slide. On the uncertainty regarding some rules, I mean, I'll tell you, the biggest one I see right now is related to that test, that first step test with the FTEs, where you calculate a FTE reduction quotient. And you say you had a 10% reduction in your FTEs, you're unable to restore it via any of the safe harbors or exceptions. Do you apply that 10% to the principal loan amount, or do you apply it to the total eligible costs? I would say a strict reading of the CARES Act says it should be applied to the principal loan amount. The CARES Act kind of talks about how you cannot count costs above and beyond your loan balance for forgiveness purposes. But it doesn't talk about where to apply that FTE quotient. But what we're seeing in practice, and I've demoed a few different softwares and looked at what different banks are doing, and I'd say it's 50-50. Some are applying it to the principal loan amount, and some are applying it to the total cost. And just so you understand, when it was an 8-week period, this didn't matter. Wherever you applied it, you were going to have a reduction. But when we're up to 24 weeks, you borrowed again 2.5 months of payroll, so about 10 and a half, 11 weeks, and you have 24 weeks to use it. So even if you had a 50% reduction in your headcount, you would still spend well more than you needed to get 100% forgiveness if we're applying that FTE quotient to the total costs. This to me is a major issue because it just seems totally unfair to the borrowers that one bank is treating it one way and another is treating it another way. And, you know, we've put a question into the SBA and we were told that it was up to the banks to decide, which again, provides, I'm sure, a lot of comfort on your end. And hopefully we get an answer on this. Hopefully there's congressional fixes that make none of this a problem anyways, but it's not the warm and fuzzy we're looking for. Going to the last slide here, and we've left some time for questions as well. You know, what additional changes from the question we had on, you know, thoughts on forgiveness of loans under a certain threshold? So we had the HEROES Act back in May, passed by the Democrat House, the HEALS Act put out there by the Republican Senate in July. And then yesterday, you know, well after these slides were submitted, the HEROES Act, light, we'll call it, was passed in the House. Speaker Pelosi and Secretary Mnuchin had been talking Monday, Tuesday, Wednesday, and when those talks kind of failed, the House went forward with the abbreviated version of the HEROES Act. So back in May, I believe it was over $3 trillion. I can't remember the total. And then yesterday's bill was 2.2 trillion. There's still some very significant differences between that and the Senate bill. And, you know, there's no chance probably that bill as is gets taken up in the Senate. But there are areas where it's common, and those are related to PPP. There's uniformity that anything under 150,000, it should be a very significantly simplified application. The bill that passed yesterday, I think for anything under 50,000, they talked about kind of signing one certification and you're good. And then for anything up to 150, between 50 and 150, it was a couple certifications. And, you know, you don't have to submit any data or payroll or anything to substantiate the amount you borrowed. You have to keep it because you may be audited for 6 years. So that's kind of common in both bills, that 150 threshold. Whether or not anything happens before the election remains to be seen. If I were a betting man, I would put it at less than 50%. If they carved out these provisions as a separate bill, like they did with the PPP Flexibility Act, I think we would see something. And the two sides have significant common ground. But again, there seems to be no one wants to pass these piecemeal bills anymore on both sides, it seems, and no one wants to give anyone a victory before the election because we don't know what the polls say. As for a simplified process between 150 and 2 million that had been batted around, that doesn't seem to be talked about as much anymore. The deductibility of the expenses. So as you recall, the CARES Act said that forgiveness is non-taxable. However, the expenses covered by those were not discussed in the CARES Act. So the IRS came out with a ruling and said Section 265 applies, which says that any expenses that are related to grant income are non-deductible. So effectively that makes it taxable. Just a quick anecdotal example, I was talking to a business the other day. They usually have about $500,000 to $1 million in net income each year. This year, they're going to be hovering around break even. However, they received a $1.3 million PPP loan. If they lose the deduction on those, they'll be showing taxable income of $1.3 million. So they're a prime example of someone that right now the cash flow doesn't justify paying the taxes on that. So they want to kick forgiveness down the road another year if they don't, you know, if we don't have a fix from Congress. But that's included again in the yesterday's light Heroes version as making it sure that those are deductible. And then the last item here is the allowing a second PPP loan to certain eligible borrowers. And initially, I think the first version of the Heroes Act talked about a 50% reduction in revenue. Yesterday's version was 25%. And I think that's consistent with the Senate bill, which, so if you had under 200 employees and a 25% reduction in revenue year over year, then you would qualify for a second loan. And I believe a loan up to 2 million. And then for smaller entities, they will allow a loan, I think, regardless of any revenue change. So that, again, we'll see what happens. Again, all of these proposals have bipartisan support, and it would be helpful if there could be a agreement, even if they had to do it outside of these two bills. But right now, it just doesn't seem that way. With that, any questions or feedback on your experience or your plans for forgiveness? Anything you want to write in the chat? We will be happy to answer.
There was a question in the chat, and he just wanted to clarify it. And it was the question is, just to be sure, a few slides back, are you saying that no PPP fees should be recognized until forgiveness occurs, either in an SBA response or actually receiving funds from the SBA?
So to answer that question, they should be amortized over life alone. You shouldn't take them 100% in. So, by, say, you submit a loan tomorrow for forgiveness to the SBA and 75% of the balance remains, the fee balance unamortized, you should not record that 75% into income until you have your decision from the SBA.
Yeah, we were just discussing the accelerated piece.
Yeah. Good question.
Let me see here. Again, anyone who has any questions, please don't let these folks leave if you have any questions on your mind. So either type them in the chat box or in the Q&A box, and we'll give it another minute or so to see if anyone has any questions.
Mark and Jamie, knowing that, we are coming up to some kind of a decision and maybe another decision on another stimulus package. And the banks probably are the better ones to answer this. How much of this next stimulus package do you think is, I don't know. I guess you got to wait to see what it is, but I'm just trying to see do we think that this next stimulus package is going to be as successful as the first one with loans out there without the first loans being forgiven?
I think, if you look at the numbers, the 5 million loans that were written, 87%, it's like 86.8% of those were under that 150,000.
Mm-hmm.
The institutions I've talked to, it's generally right around that 80 to 90% range as well. And I think that just having that burden taken off your plate, that your borrowers can just sign a certification and you will not be, held accountable for what's behind that. I think that will free up a substantial amount of your resources to get back to, what you do best every day. And that alone, I think for the banks would be a huge sigh of relief. As for the second round of loan, I mean, I don't know, it seems like the proposal has a fair amount of restrictions on who can make those loans and who can receive them. It may not be as wide reaching as the first round was. I mean, it's not going to be as wide reaching, right. But even so, you may not have much of an impact, even if you open up to it.
Any other comments or questions? I know Bob just came back and said 92% of his loans are under 150, which would clean up his at Tioga, and I'm sure there's others that have the same thing. I mean, you talk about 87% of the loans being under 150. That would make things, like you said, hopefully very easy and hopefully very efficient for people to get those off the books. But let me ask you this. Have you heard anything about third parties, and I use the online lenders or kind of the third party, the non-traditional banks getting into the game here or being a part of this. You know, I know that we have Cabbage was one that I think got pretty much shut out during this whole time. So I didn't know if there's any other online lenders or any, you know.
I've seen, I would say the borrowers that had the toughest time with traditional banking, that's where I think they turned. I mean, some of these have a physical presence somewhere, but they also have a much more substantial online presence. That's where I've seen them come into play, though. I haven't seen them, picking off your a credit clients or anything like that.
Yeah. Well, again, I mean, a lot of them aren't deposits, but it's just kind of interesting. It's a whole interesting time period anyway. But any other comments or questions?
We did just get one more question in the Q&A box. In your opinion, does the SBA have the manpower to process forgiveness if 150K is the number they choose, and lower loans are not simplified more or automatically forgiven? So basically, do you think they can accomplish this if that number of 150 is what they choose? Do they even have the ability and the manpower to do all this? Just your opinion.
I don't think that threshold actually matters to the SBA because they can give a blanket seal of approval to any loan under $2 million. The $2 million plus are the ones they have to audit and review.
Thank you. And I believe that was the last question for now. So like everyone else, if we end up having some questions afterwards, we'll make sure that we get them to you so you have an opportunity to answer those. Thank you for your time.
Happy to do so. And thanks.